Let's get in Pramod Gubbi, VP Institutional Equities at Ambit Capital, joins us from Singapore. So much to speak about, Pramod. Let's start off with the bounce that we're seeing in commodities across the world, and therefore, because of that, in the commodity names in the listed space in India as well. What's the sense there? Is a large portion of what a lot of people believe is a dead cat bounce already over?
Yeah, I would guess so, because I think nothing's changed on the ground in terms of the demand and supply, which should be driving these commodity prices. At best, you can point to the fact that you had a pretty bad jobs data in the US, which has pretty much spread the word across markets that the liftoff is still very uncertain. At best, there's a good chance that it could be even put off, which means that the low interest rate regime could continue that much more. To that extent, I think it's more liquidity sentiment driven than anything to do with underlying demand or supply changing. So I would think this is more short-lived.
Why do you think this is short-lived? Let me just throw in the bullish argument, and the bullish argument is that global emerging market currencies have stabilized, global commodity prices have stabilized. Foreign institutional sellers are no longer selling into Indian markets. So if I look at the technical setup, it is not as stormy as what we saw in the month of August and September.
The sentiment has turned positive towards risk assets because the markets have assumed continuation of the low interest rate regime. But I guess the underlying economic drivers, be it in emerging markets or developed markets, haven't changed much in the last 1 week. If at all, there are more questions being asked in the sort of economic fundamentals in these markets. And to talk about low interest rate regime, I think in some ways it's already changing with or without the Fed actually hiking. If you look at the sale of treasury assets by emerging markets as a whole, that's already reflected in cost of capital going up in developed markets, and that's just the beginning. So to that extent, irrespective of whether the Fed hikes this December or 3 months hence or 6 months hence, we are set for a rising cost of capital globally, and that means risk assets will be out of favor for some time to come.
And Pramod, tie this in. I'm just taking the cue of the rupee to actually talk about IT, because we'll have a kick-starting of the IT results with Infi, followed by TCS and HCL Tech within the next 6 trading sessions. How do you think this index performs? Because few of these names have corrected quite a bit in anticipation of poor numbers.
Yeah, I think 2 things. One was the Accenture commentary after the results last month, which raised a lot of concerns. Again, very similar to what the whole world or the markets in general is concerned about. It's the strength and the resilience of the global economy, both across developed markets and emerging markets. And that resulted in Accenture downgrading the guidance, which raised questions about the demand environment for IT. And then we had our own HCL Tech sort of highlighting certain headwinds, although most headwinds that HCL Tech highlighted seem to be company-specific than market-driven. Broadly, those 2 events seem to have created some question marks in investors' minds upon the sector. But in general, I think we don't see any major changes in the demand environment. We're working with a base case of a stable environment going forward. To that extent, I think most of the top guys, particularly TCS, Infosys, other than HCL Tech, who we know after the profit warning, TCS and Infosys should maintain reasonable QOQ growth rates. There's also a tailwind coming in from currency that should result in some sort of margin expansion. So overall, this should be a decent quarter for the sector.
Just before we let you go, though, one cue on the real estate names. DLF is in focus today for the company announcement as well. If you have a view on that one or the real estate space at large.
Look, the company-specific deleveraging efforts has been much wanted for a long time. It's a clear positive that it's finally happening. We desperately need these companies who will participate in the next capex cycle, next investment cycle, to delever these balance sheets and be in a position to start investing in building assets again. Having said that, the overall environment for real estate still seems to be a bit uncertain. The rate cuts are certainly a positive, but definitely not the only factors in reviving real estate demand yet again. I think the more important factor is for a reasonable correction, for affordability to improve, and that's what buyers would watch out for rather than a 50 or 100 basis points cut in interest rates. We haven't seen that happening. We are seeing slowdown in transactions. At some stage, the slowdown in transactions should also result in drop in prices. I think in some ways it is a big positive for the industry if there is a correction in prices, because that will bring in a new set of buyers, revive demand, and that can have a knock-on effect on their own balance sheets and P&L.
Great. Pramod, it is always a pleasure chatting with you, and thank you so much for taking the time out today as well and giving us your thoughts.
Welcome.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.